Good afternoon, everyone. Welcome to a special Raintree webinar where we are launching a new relationship with a great group called Turtle Creek. Now, those of you who've been on these calls, you know that I always have theme music at the start of the calls because it's sort of awkward at the beginning. So if anybody can put in the chat box the significance of the song I just played for the group that we're working with today, you win. What do you win? A membership to the Jelly of the Month Club, I think, something like that. I'll be really curious if anybody gets it. It's silly, but it's good. So anyway, we're really excited to have the team from Turtle Creek on today. We have Turtle Creek CEO Andrew Brenton with us today. Andrew's a very busy man, and Avita is too. So really grateful that you've taken the time. And for now, Avita is the Associate Director of Advisor Relations. I understand that title will be changing January 1, so this will be the last time we get to call her that. But promotion on the rise, so congrats for that, Avita. And everybody, this is really great. Thank you for tuning in. I know we're all busy. I know, you know, there's Christmas shopping and Christmas parties and all those things. So we're just grateful you took the time today. The format for today, it's the same as the other calls. Please use the Q&A box for your questions. We are going to make sure to try to get everybody's questions answered today. And by the way, if your question doesn't get answered right away, we will save it for the Q&A. So some will get parked till the end, some will get addressed right away. And I already see there's a few people who got the special question right. The song was written by the Turtles. So there you go. Owen Jackson was the first to say it. I think he wins a Jelly of the Month Club. So with that said, we're going to turn it over to you. I'm going to turn my camera off just to save a little bit of bandwidth, but I'll be here the whole time. So over to you.
Great. Thanks, Adam. You can see the turtle on the screen and the corporate catch line, which is a different kind of value investing. I'll touch on how I think we're different, but in the slide presentation, there's another catch line on alternating slides, which is a better kind of private equity. So in fact, that's the background that I have and my two partners who founded Turtle Creek with me over 20 years ago. Previous to Turtle Creek, we set up and ran a private equity fund for one of the large Canadian banks, the Bank of Nova Scotia. And we were successful doing that, but we kept seeing what we thought were better run companies in the public market, cheaper valuations than we could ever get invested in private equity. Now, we couldn't get control, and we're not trying to get control of these public companies, but we can get invested at much more attractive valuations. And then we moved from being board members and all of the time and effort that takes. And instead, with the public companies, I describe us as we're very engaged shareholders, but we don't sit on boards. It wouldn't be right to think of us as an activist investor in the sense that we're not going and looking for undermanaged companies and try to do something to make them better. But we are engaged. We do spend a lot of time, overtime, chatting with the companies that we follow and own. As a quick overview of Turtle Creek, I mentioned already, we started 23 years ago. And as an aside, or as an important point for you being new to Turtle Creek, the plan is for me and my two partners to continue to do this for as long as we can. And so hopefully that means into the decades from now. But also, and you can see on this slide, we have 9 additional investment professionals on the investment team through a whole spectrum of ages. I was shocked to hear the other day that Cameron McKendry, our longest time member beyond the 3 founding partners, turned 40. He doesn't look a day over 30. But so we hire these people generally fairly fresh out of school. They learn to think the way we learned to think back when we were private equity investors. And we've had essentially zero turnover in the investment team over the years. And you can see on the overview slide, we are absolutely North American public equity manager, not European or Asian. That may change at some point, but as I describe our investment process, I think you'll understand why to date it's just been North America. And in fact, in the first decade, we were exclusively Canadian. So we're trying to find great companies. It's not easy to find the great ones. I can hit a button and get a long list of every public company, but trying to figure out which ones are remarkable is a very long and arduous process. And then, of course, you have to keep ensuring that the companies you've identified as being remarkable maintain that remarkableness, because the companies can lose their edge over time. The companies we own are all profitable. They're all generating cash today. They all have strong balance sheets, not fortress balance sheets, but strong balance sheets. And so, and we manage about 5 billion Canadian in assets. So we're a reasonable size. We have a lot of capacity at this point. And that size of AUM gets us, in a sense, time and access with management teams over time. Evita, I think we might have skipped ahead, right? And then I guess the only other comment I'd make, important for you as you're new to Turtle Creek, the process is repeatable, and also the fact that it's teachable. I mentioned the 9 professionals beyond the 3 founding partners. It's exciting for us to see the caliber of work that the team is doing now compared to 10 or 15 years ago. We think we continue to get better at what we do. And then the last point on that slide is really important. The fact that we do take a long-term view and a long-term focus. It's actually very rare in the public market to have a manager that is truly looking out to the very long term and not letting that short-termism and short-term noise affect our holdings or what we do. So then moving to the slide, this is important in particular because of the returns that we've earned. It's always an important point that we make up front. Everyone's been taught, if you have earned higher returns, you must have taken higher risk to do that. That simply isn't true, at least with our approach. So we're actually focused on trying to create the lowest risk portfolio from the asset class we're in. We're in public equities. We want to own companies. We want to be owners of companies. But once you set that parameter, we then try to construct the lowest risk portfolio. And to us, that means, obviously, from the great companies we've identified, being incredibly valuation focused. The greater the margin of safety of a company, in other words, the gap between the value and the current share price, the less risky it is. And for us, the more we want to own in the portfolio. But of course, if you have a larger margin of safety, the inverse is your long-term expected returns are actually. So it is a very risk minimizing strategy that has resulted in higher returns. This is where all of my family's wealth is invested. I have no investments outside of Turtle Creek. Our view was always, if something's good enough for us, it's good enough for our investors, for our partners. And so it's 100% of my family's wealth, 100% of my 2 partners' family's wealth, and we don't want to lose any of our money. And that's why there's such a focus on risk mitigation. We tend to own companies in unrelated industries. It's not a top-down approach. We're trying to identify the smartest company in an industry. It's not, you rarely find 2 fantastic companies in the same industry. So we end up with diversification across sectors. I've mentioned already, we're exclusively focused on free cash flow. We like companies with strong balance sheets, but we like our companies to actually intelligently use senior debt in their capital structure. And it's one of the things that we engage with our companies on. And then I've mentioned already that maybe the most important thing we do is trying to identify these highly intelligent public companies. And then, of course, the price of an investment is the biggest risk factor. You can invert the relationship between risk and return if you do it right. So then, just moving to our investment approach, it's a 4-step process, and it is, it hasn't changed in 23 years. As I mentioned, I think we're getting better at it. For sure, we're covering more companies. As you grow from 3 professionals to 12 on the investment team over a 15-year period, the big change is we're simply able to follow more companies. Not increase the number of companies we own at any point in time, but have more choices, have more companies to pick from. And that was a long-term objective. We intend to continue to grow the investment team so that we can follow even more companies, but without losing that ability to compare company 1 to 5 to 100, because that relative valuation is one of the critical elements of successful investing. So what are our 4 steps? We pick the right kind of company. We then spend on step 2 most of our time valuing that company and getting to know it as best we can. Step 3 is sizing an initial position into the portfolio. And step 4 is really step 3 over and over again, what we call continuous portfolio optimization. And if you think of us as former private equity investors, this feature of the public markets that frightens most people away or frightens them in the moment is something that we embrace, the fact that the marginal share price keeps fluctuating in both directions. We think it's one of the fantastic things about the public market compared to private investing. So to move back to each of the 4 steps, when I say picking the right kind of company, I've talked about highly intelligent, but that catchphrase at the top, a different kind of value investing. Where we're different in this first step is, yes, we want to find highly intelligent companies, but a real bonus is if they're unique, one of a kind, that there aren't a bunch of other companies that are in the public market that the market can then compare company A, B, and C. And we've never owned the Canadian banks, but I noticed a research report just yesterday as I'm scanning through the research early in the morning, and just one of the analysts, I think it might have been the BMO analyst, just going through chapter and verse on Bank of Nova Scotia versus TD and the minutiae and the work that he's done comparing each company. And I would step back and say the chance that one of those companies gets really mispriced compared to the others isn't very high. If you look at the kind of companies we own, in most cases, there are no what's called comps. There are no comparable companies. And that's a feature of what we do that, our thought process is we're going to do a lot of work on each of our companies. Wouldn't it be great if they're likely to get mispriced at times? And unique companies that the market has trouble understanding have much greater prospect for mispricing. But I'd stress where they're understandable. So in other words, we'd never look at a drug discovery company, a biotech company, because that's not something that we would be comfortable we could ever get our arms around. But the companies we follow and own are reasonably complicated, but where management devotes some of their time to their owners, like us, to explain the business, explain where they think they're going, which allows us to then do the work in step 2, allows us to really get our arms around what we think the company will look like in 2 years, 5 years, 25 years. And so those 2 first steps, the building blocks of remarkable companies, and then doing the fundamental work to have a view of value, then prepares us for steps 3 and 4, meaning when we add a new company to the portfolio, we have a way to think about what size weighting it should be initially. Should it be 2.2%? Should it be 4.1%? And that framework really is driven by a host of factors, but the big one is, what do we think we'll make by just buying this company at this price over the next 5+ years? And obviously, the more you think you'll make, the better it is, as long as it's on a risk-adjusted basis. And so that portfolio construction, that initial sizing is a key step. It can only be done after having completed steps 1 and 2. And we don't change our companies that often. So think of it as we tend to add a new company once a quarter. So over 23 years, we've owned a total of 107 companies in the portfolio. It's not a high turnover in names, and it's driven mainly by finding a better, but importantly cheaper company than currently. So as an example, the most recent addition this year, it's an American company. We think it's remarkably attractive from a valuation standpoint. As we've added it, we've made it around a 5% position right out of the chute, which is unusual. It's nice when it happens. But then we had to remove a company, and we removed a Canadian company you probably have heard of called Couche-Tard, a very well-run company. We will continue to follow Couche-Tard. It wouldn't surprise me if it came back into the portfolio at some point, but it's simply that discipline of continuously trying to optimize the portfolio. When we look to add this company and then turn to say, well, we're going to keep the number of holdings at 30, what do we remove? It was obvious we needed to remove Couche-Tard because it was only a 1% weighting, and it was getting close to what we think it's worth. In other words, the buy and hold return of Couche-Tard's a lot lower than the buy and hold return for the company we've just added. So that's our, call it our investment approach. And then this is a nice way to show our returns over time. It's my favorite way of showing it. We have a line graph as well in the slide presentation. This shows on the left the growth of the dollar. So we've compounded our returns at around 20%, and often people don't appreciate the math of what that can mean for you if you do it for a long enough period of time. So we've grown $1 to $80 in the 23 years. And if you were in the market, you'd have $1 growing to $5 in that same period. But on the right, this simply takes our aggregate returns of $1 to $80 and puts it into the 6 distinct market periods since we started. And it's funny, until a couple of years ago, we had 5 distinct market periods, obviously. And I would say, we've been around long enough. I think we've seen everything, but I hadn't been expecting a pandemic. So now we've got a 6th kind of market being since the COVID hit us all. And when you think back to my comment of a continuous portfolio optimization, when markets are really volatile, that's good for us. One way to state it is, if there had never been a credit crisis, our unit price wouldn't be as high as it is today. And in fact, I can say now, if there hadn't been a COVID crash last March, our unit price wouldn't be as high as it is today. We're able to take advantage of market dislocations because I think we have the temperament to buy when a lot of people are panicking. But importantly, it's what I said a few minutes ago, we've done the fundamental work to know the value of the companies that we own and follow. So we don't think of it as being especially heroic to have bought in a targeted way certain of our holdings last March at lower and lower prices. It's the same thing we did in the credit crisis. And it really, we're doing it all of the time. But when markets are volatile, like they were in the dot-com bubble in 99 and 2000, that's kind of the ideal environment for Turtle Creek in terms of adding beyond a buy and hold approach with the fact that share prices fluctuate. What I like about breaking these into the different markets, though, is it points out a few things. One is, we're not hedging in any way. we're owners of companies. These are publicly listed companies. So when the market crashes, like the credit crisis, you can see we were down almost as much as the market. We were down actually a little more than the market last March in that 1 month. So we're not hedged in any way. We're owners, but we stay invested. We made sure that by the end of March last year, we were fully invested and stayed fully invested over the ensuing few months, reacting to relatively different changes in share prices. The last thing I'll comment on this slide is that middle bull market. If you remember back, that was the commodity super cycle bull market. And we've never owned an oil and gas or mining company. So it's that this slide is a helpful reminder for me to always make that point, because many investors, especially foreign investors, when they see a Toronto-based investment manager, they just assume that they're heavy on the resource side. And like I said, we've never owned a basic resource company. It's not to say we never would, but we never have. So that's the approach. That's one way of looking at our returns. And then I think what I'll do is spend some time on a case study, and then open things up for Q&A. And we have these case studies for many of our longtime holdings. I think this is my favorite because it captures a bunch of different elements of our investment approach. So there are three things on this slide. The black squiggly line, of course, is the share price over a long period of time. And I'll point out that the share price is on a log scale. So look on the right y-axis, log meaning it goes 2 to 4 to 8 to 16. Because when you first glance at the slide, it might look like the share price hasn't really moved around that much, but over the many years it has. It's been as low as $3 since we owned it, and today the stock's at $50 and has moved around a lot in the interim. So the black line is the share price. The green line is our valuation work, the business value of the company. You can roughly think of it as if this company ever decided to sell itself, what someone might pay for the whole company. So we actually don't expect any of our companies to trade at that price in the public market, although many companies we follow today are trading above that. We just don't own any of those companies today. So that's the second thing on the slide. And then the third thing on the slide shows the portfolio weighting of this holding over the years since we've owned it. And you can see in the early period in 2009, in a couple of periods, it actually briefly snicked above 15%. So we don't have any limits on how big a holding would be in the portfolio. But the limit is we force the portfolio today to have 30 holdings. So as a result, today our biggest holding is 11% of the, and I would like it to be 13 or 14%. In other words, I would like the share price to be even lower so we could make it a bigger percentage of the fund. So there are no artificial caps on the weightings. We handle risk through knowledge. So that weighting, you can see how it's fluctuated over the years. Today, it's about a 4% weighting in the portfolio. So it's actually one of our top 10 holdings today. But because we've altered the weighting, bought and sold at different times, you can see the bullet below the slide. We've earned a 26% compounded return versus a buy and hold of 20%. And we all know a buy and hold of 20% is really good. So we're trying to find companies where if all we did was buy and held them, because when we've added ATS automation, we didn't know the share price would keep going down. So we were able to make it a bigger and bigger holding. But from our entry point back in 2009, the share price has gone up tenfold. A lot of it coming quite recently in the last couple of years. So that's that long-term approach. And then we've improved upon that buy and hold to the tune of about 600 basis points a year. So we can find companies where we enter that a buy and hold will be pretty good, and this one's been really, and then improve upon it through the fact that markets will fluctuate and we can improve upon a buy and hold. The reason why, sorry, Avi, if you could just go back for a second, just want to point out the reason why the chart begins 5 years before we actually owned it is we visited the company. They're based in Cambridge, Ontario, just outside of Toronto, and we didn't understand the strategy of the company at that point. So we spent a day with them and essentially closed the file. But then years later, an activist investor from New York came in. They had a fight. I read about it in the paper and followed it. They won. They changed the board. The new board hired new management. We went back down to visit the company in 2007. And that's when we said, okay, now it's interesting. Now it has a strategy that makes sense to us. It has a management team that we think are pretty good. And we began to do work. But then you can see that green line initially was actually below the share price. So we thought, well, it's a company that meets our criteria, but it's fully priced in the market. What happened over the next year or so, though, the new management team continued to turn around the business, improve the business. And in the meantime, with the credit crisis, the shares were going the other way. And at a point, we added the company to the portfolio, and then the share price kept going lower. And that's how it became, at that stage, the largest holding in the fund. So it is very long-term in approach, and we are obsessing all of the time on management of each of our companies, because 5 years ago, the board decided that the person who had turned around the business, the CEO, was not the right person to really grow the business. And they found someone to replace him. They recruited someone out of the US. He's fantastic. He really is the person we think, to really grow the business. This is a global automation company enabling large corporations to automate processes. And you can see that green line, how much it's increased in the last couple of years, as we've seen evidence of the newish CEO and the management team and the work they're doing, both to grow organically and to grow through acquisitions. And so now, Vita, I think we're about to maybe go to questions, but let me just quickly touch on current valuations, because if you read about the fact that the stock market, it is at all-time highs, and the market is trading at pretty lofty multiples. And you can see some of the representative indices and the higher multiples they trade at. And then you can see our multiple based on next year's earnings. And I did point out earlier, this isn't something we look at as a way to construct a portfolio. This is simply a shorthand outcome so that we can say to investors, you know, you can believe we do big cash flow forecasts, discounted back, but by the way, just on a simple current multiple of earnings, the portfolio is trading at a single-digit multiple, which in a sense is pretty remarkable given the high multiples in the market, but importantly, a lower multiple with higher earnings growth. So we think the earnings, if you think of it as earnings per unit of Turtle Creek, more than double in the next 5 years, and then double again in the following 5 years. So lower price earnings multiple off of current earnings than the market, quite a bit lower actually, but with higher growth than just owning the broad market. So I think at that, I'm pretty much 30 minutes. So perhaps, Adam, we could see if there are questions.
Yeah, for sure. There's a couple kicking in here. In your last annual letter, Gildan was discussed. Further elaborate based on that 2020 data, please.
Sorry, on the 2020 data?
He put this up 5 minutes ago, so you're on a slide 5 minutes ago. I'm guessing it had something to do with that.
Sure. So, yeah, I think probably. So what happened, I'm thinking back to our 2020 annual letter. So what we did in Q1 of 2020 when the pandemic hit is we put each of our companies into one of three buckets. We said, companies that are pretty much unaffected by a deep recession, pandemic, a couple that actually could be helped by that. We own a very large, well, the largest plastics company in the world, and their health, hygiene, and safety, which is 20% of their revenue, but really a bigger proportion of their profits, was really helped because they're making surgical masks all around the world and surgical gowns and things. So we put companies like that in bucket one. We put companies that we thought, they're going to be impacted, but they can probably take advantage of it. So, think of an ATS automation. Sure, they might be harmed in the short term, but maybe there are opportunities to buy weaker competitors, which is exactly what played out with ATS. Although it turned out they weren't as negatively affected as we thought they might, because a big part of their business is the health industry. They did COVID test automation assembly lines for a client in New York State. So they actually pivoted and won a lot of business relating to the pandemic. We put Gildan in the third bucket. Of all of the companies that we owned when the pandemic hit, we thought, wow, this one's the most impacted negatively. Because if you think of Gildan, they do men's underwear, they do socks and things, but their biggest category and where they began was blanks, like t-shirts, sweatshirts for sporting events, rock concerts, any kind of social gatherings, corporate events. Essentially, that business went to zero in March of last year with all the lockdowns.
Right.
And they closed their plants in Central America for some extended period. But the good news about their business is they don't make fashion items. It is the basic clothing of t-shirts and fleece, and the amount of casual wear that people have been wearing. This is the first time I've had a tie on in a while.
This suit had dust on it when I grabbed it out this morning, for sure.
So we really were cautious about Gildan, and in fact had a number of conversations with the CFO, who's extremely strong, about their banking situation and about their lending syndicate and would they have any issues. And they didn't have any issues, but they did have to go to the table with their lenders because their revenue went down sharply. In fact, believe it or not, that by the end of 2020, their revenue was similar to 2019, and they're now well above. They've, as quarter by quarter has gone by, they've crushed any expectations we had and the market. So the stock has more than fully recovered from pre-pandemic. And if you think of our continuous portfolio optimization process that I've talked about, we did less of it last March in the COVID crash than on an average month, other than making sure any dry powder we had, we got invested. So in a sense, there was a lot of buying because we had capacity, we had dry powder, but there was less, trimming and buying across the holdings because everything went down.
Right.
Fortunately for us, while it seems like it was pretty much a V recovery, overall for the market it was, but inside that, some of our companies, like the plastics business that recovered quite quickly in share price, we were able to, as an example, trim that, and we'd held off buying Gildan with the thinking that, with how ugly things are with lockdowns, that share price probably isn't going to recover as quickly. So it was playing a little bit of market, but it worked out well. And so by the summertime, though, we were able to size and buy a lot more Gildan in the high teens. It didn't continue to go down. It just didn't recover. And now it's still a top 10 holding, but we've sold an awful lot of stock now with the stock at $53 today. And it's that process is why I said Gildan is another example of our returns over time are better than a buy and hold, but I'm pretty comfortable that Gildan is sitting at any price. If you give it enough time, it will be a good outcome for their shareholders. It's still run by the founder, CEO. It's a good one. And what's interesting is that they have, they've taken share in, for example, the e-commerce category, Amazon. And so as we're now seeing more sporting events, more gatherings occur, they're going to end up with a lot more revenue than they had a couple of years ago, because in the meantime they've taken share in different verticals.
Right. Changing talk. Actually, there's a question in here I'm gonna get to in a little bit, but I've got a couple written down that I think are gonna kind of dovetail nicely from what you just said. I think there's a lot of people that look at the equity markets in North America and they see how, inflated a lot of things are, and historically, when things get this inflated, there's a chance that there's going to be a correction, and most people would say it's not a matter of if, it's a matter of when. It's not a matter of how much, things like that. But there's a big difference in the way that you are investing versus buying an ETF that's just in Canadian equities or US equities or North America, whatever. Can you give me the biggest difference between the way you approach the equity market and blindly investing in the equity market? I mean, you summarized it earlier, but if you could put it in one thought, Andrew.
It's the intense focus on valuation. I mean, in a way, the biggest risk that a long-term investor in the stock market has, it's not the risk that their portfolio goes bankrupt. I mean, maybe it happens with one company and they have to do a restructuring, but a broad portfolio, that's not the risk. The risk is valuation. Right. We wrote about Fairfax Financial years ago, not to pick on Fairfax Financial, but to say, look, at that point, a 30-year period of owning Fairfax since it went public, you had something like a 24% compounded return. But there's a 15-year period. So think of that, 30 years, there's a 15-year period. Now it's probably an 18-year period where you really would have made no money.
Right.
If you bought it in 99, you've made almost no money. It's a good company. And even since 99, they've grown their business significantly. But so I think the biggest risk, and it's the risk that people face today by just, if you will, blindly owning the market, is there are companies trading at 100 times earnings or 10 times revenue, wherever that comes from, because it isn't revenue you care about, it's earnings. And I understand you can distill that down to margins, but to me, that's the biggest risk. So what we're doing is we're owning the portfolio that is in a sense, the cheapest valuations, and I think therefore the lowest risk. And our biggest holding I mentioned is about 11% weighting. It is ludicrously cheap. And I don't really worry about, well, why does the public not like it right now? I think their CEO, he's a terrific CEO, but he's a little tone deaf when it comes to how he talks to the market or talks to the shareholders. It's plastics, so maybe people think that's a bad thing, bad from an ESG, and yet I think we've all learned from the pandemic how critical the medical use for plastics is and will continue to grow, whether that's food safety and wraps. They don't make straws. They actually make that replace the straws for Starbucks coffee cups. And when I say that, people go, oh, I hate those. But they're the ones that make that. Right. They make product for diapers, both for babies and for adults. So there are a whole host of products that they make and they've got organic growth, and yet it's not in favor. And it's interesting that a group in the US that know the company pretty well, they were saying, I think it's going to go through a re-rating process. And I said, I don't know, maybe, but if it does, and it trades at a much higher valuation, it will no longer be our biggest holding. So I think it's because of that active management. And then the way to think about the public market, even in this environment, there are always companies out of favor. We've been at this 23 years through all these different market environments, you can always find companies that the market hates, that they put into the penalty box. I mentioned earlier Couche-Tard. Couche-Tard's not on the penalty box now, but I could see a scenario where when the shoe drops for the average investor, that fuel volumes are going to decline, gasoline volumes in the US, in North America, as they're now declining in Europe and as they've really declined in Norway. I could see a scenario where that company gets put in the penalty box. So, and again, it's not in the penalty box now. We don't own it. It's the key thing that we're doing is this constant drive toward, I guess, in essence, the things that are out of favor at any point in time in the market from good companies. That is, remember, the critical threshold. Badger Daylighting, which is a Western Canadian company, but dominant hydrovac operator in North America, they have disappointed 4 or 5 quarters in a row now. And if I go back to the pandemic, remember I said I thought Gildan would be the most impacted. We thought Badger would be almost the least impacted. You're working outside, there's all this critical infrastructure, and yet they've been really impacted. And so they're increasingly in the penalty box. Finally, I've been hoping for quarters now. Every time they report, I think, great, at least there's we're going to get to buy this, and it hasn't really gone down. But if you pull up a chart now people have finally, are they throwing in the towel on the company? And so we've now been able to buy quite a bit more to make it a bigger holding in the fund. So it's that constant, what's out of favor, I guess, from good companies.
Yeah. Okay. That's great. You mentioned the Fairfax story and kind of the skewed data, the skewed returns. When we look back on your 23-year history, have you ever looked at what your best 5-year period was versus your worst 5-year period? Is there's some data on that?
Haven't really. There is a slide, I don't know if it's in the deck that we have here, that looks at all 5-year periods, all 3-year periods, and what that looks like in terms of buckets. There, Evita, if you can jump to slides 12 and 13, which are kind of takes a bit of an explanation. So that's slide 13. Here's 12. This takes a second to explain. This is saying take all 3-year periods. So like November 98 to November of 01 and December, like just all 3-year periods, and drop them into the buckets of, where those 3 years was at -20 to -10, and doing the same thing for the market. And I think what you can see is we've shifted to the right. So it's not like we've earned higher returns, but then you can live through, you're going to have worse 3-year periods than if you just own the broad market. So, and you can see down on the right side, we've outperformed 82% of the 3-year periods. And then even our worst 15 periods, which is just, we were taking the 6 and the 9, with our 15 negative 3-year periods that all happened around the time of the credit crisis. Right. You see the average negative experience was actually less than the worst periods in the market. So we have, I think of it as shifting to the right. And if the other slide that Evita had up a second ago, this one is just, you can see that 82% for all 3-year periods. That you can see that from the previous slide. So it's like the more time someone gives us, the more often the we have relative outperformance, and then you get to 10-year periods, and we've never, and there's a chart, we've never underperformed the market. In terms of worst 5 years, best 5 years, really haven't looked at it that way. But the one thing I would say is, I don't think this is a term when people look at funds, but we've heard from a lot of groups that they've never seen the kind of bounce back that they see with us. In other words, think of when anytime there's a double-digit drawdown. So that would have obviously been COVID last year. It would have been the credit crisis. And that's happened to us maybe 7 or 8 times, where an investor would have said, okay, I came in and now I'm down 12% or I'm down 15% over, let's say, a 6-month period. Our speed of bounce back has historically been really strong. You look at it 12 months later, 24 months later. And again, I think we're buying more of the companies that are down with our unit price being down. And that's the right thing to do because we own good companies. And almost always, well, really always when that's occurred, it's been market related. It wasn't our companies last March, it was COVID, which gave us the opportunity to, if you want to think of it as averaging down, I don't think of it that way because it's continuous and it's symmetrical. It's not just buying when things go down, it's selling when things go up.
Right. So, and just to be clear, I mean, make this point very clear, because we don't want any surprises for anybody investing here, if and when that, the next correction happens. But you're not saying that you don't drop when there's times of volatility. You do. In fact, sometimes you may even drop percentage-wise more than the market.
Yep.
Your differentiator is in how fast you recover. Fair?
Yes. Yeah, exactly. And I think I have a theory about this, and maybe it got proven last March. I made the comment earlier, we don't own household names. We don't own the big banks. I remember back around the time of the credit crisis, every investor I spoke to who owned the banks said, well, I'm never selling my banks. I sold everything else, but I'm never selling my banks. And I thought, I'm not sure that's the right strategy, but so we don't own those big household name companies. We think we own, frankly, better companies. For sure, we own them at more attractive valuations. Right. So absolutely, last March, our unit price went down more than the market. I don't know why. And maybe the next time that'll happen again. It didn't quite happen that way in the credit crisis. You can see back to that histogram. We were down a lot, but just not quite as much as the market. But we would never argue that, the share prices of our companies aren't going to go down as much. Frankly, I hope that they go down more. It didn't bother me. I viewed it as an opportunity when the share prices of our companies went down more in March. The one thing that we've done, and I think someone said they'd read our annual letter from last year. If you go back and look at our old annual letters, we've always talked about this portfolio business value, or call it intrinsic value of the portfolio, and how for any long-term manager, you should look at that as opposed to the unit price in the short term. Now, once you get past 5 years, we could tell you wonderful things about our improvement in intrinsic value. You do have to see it showing up in the share prices and the unit price sooner or later. We've only ever put it in our annual letter, and starting last March, we thought, no, you know what? Let's give that tool to our investors every month. So in our monthly fact sheets, we include change in portfolio business value or intrinsic value. That's our own internal calculation. No one else does that kind of work, so no one else can produce that number. It's not our unit price. And once in a while, I'll meet with a group. I was in Calgary last month, and guys, I want to be clear. This is your unit price, right? These returns are your unit price. Absolutely. This portfolio business value is simply a tool. So when we said to our investors last March, at the end of the month, look, our unit price is down like 30%, but we think our intrinsic value is down about 3%. So think of us, we took our value in Gildan down. Turned out to be wrong, but we did take it down at the but in aggregate, it was 3% because a lot of our companies, we didn't see any long-term change to the business. Our investors who listened to that, and some did, added money last March and in April and in May, and actually in February, the month before, because if you remember, it wasn't just in March, the market started to crack in the second half of February. So that's a tool that we can provide, we essentially provide to our investors that help them think about how we're doing. And we've got an Ottawa-based investor who years ago emailed me when he read the annual letter, and he said, what a great year, because we were making the point, we think intrinsic value is up 20%. Our unit price was up 4%. And at first I wondered, is he just pulling my leg? He's teasing me, but I realized, no. He gets it. He really understands it. So
Right.
our unit price is up a lot this year, 25% or so. That's just short-term noise. The good news is our portfolio business value is up a similar percentage. That's the number that I focus on in anywhere near the short term, and not the market fluctuations.
Yeah, what's real versus the hype.
Right.
Yeah, it makes great sense. Okay, there's a bunch of questions that are coming in here. I have one more of my own that I'd like to make sure gets here too. Talk about the liquidity, right? Like when you do this through Raintree, it's a different structure for a company like yours. What kind of liquidity can investors expect here?
So we have, the underlying portfolio is highly liquid, but we have monthly subscriptions and monthly redemption. And when we started Turtle Creek, we wanted to make sure that the flow of money didn't change the portfolio. Remember, this is where all of my family's wealth is. So I thought, money coming in or leaving, I don't want to have that change the portfolio. So we do require 5 trading days notice for redemptions. And any large investment, we need 5 days notice, so that we know as we're coming into the final 3 days of the month, okay, there's 20 million coming in and there's 20 million leaving, so there's nothing to do.
Right.
Or another month, there's 30 million coming in and there are no redemptions. Well, we have something to do now. We need to make sure that in the final few days of the month, we essentially replicate the portfolio, so that as an investor, it's as if there were no flows of funds. I remember just around post-credit crisis meeting with a family in Quebec City, and they were saying how they were patient. They stayed in with a couple of managers. The problem is other people redeemed and they sold all the liquid stuff and they ended up with a very different portfolio, not as good a portfolio, by staying in. And I explained to them that would never happen with us. We will either redeem across, like sell shares across all of our holdings in proportion to meet net redemptions if we have them. It hasn't often been the case. We've had net redemptions. And then equally, obviously, buy things to replicate the portfolio. And by the way, that agency effect is one of the things that keeps frothy markets up, because like in the .com, investors were chasing returns. They were allocating to managers who were owning the go-go stocks. And of course, what do those managers do? They do the same thing we would do. They get money in and they buy the things they already own. And so, you can have that effect occur for a really long time. So that's and the other comment I'd make is that our investor base is very diversified, both internationally and type. There isn't, 1 or 2 big institutions that if they change their mind because they have an investment committee meeting would have any kind of an impact. We have a really, if I can use the word, fragmented investor base, which is good for everyone, because you don't want a concentration where one person changing their mind can force a manager to have to sell a lot of each position.
Right, for sure. And follow-up question to the liquidity, the returns, are these, does anything come out as dividend, or is it all growth?
It's all growth. So when you see the unit price, that's just, you can take the unit price, and if you were in 20 years ago, and you can do a calculation on what the compounded. There are no cash payouts.
Right.
So it's all reinvested. Now we do have, and in fact, I think, Avita, there's a slide in the deck that we do have a distribution class, because about a decade ago, a lot of our longtime investors were asking about, that fundamental question, which is, how much can I take and not eat into my capital? How much can I spend and be comfortable in 10 or 20 years that after inflation, I don't have less money? Because my experience is most people are happy if they've been successful, they're happy spending that, but they don't want to treat their wealth as an annuity that goes to zero. They do want to pass it on to their heirs. And so we have a D1 and a D2. So we started this, what we call the endowment model distribution, that is roughly a 4% annual dividend. It actually comes out as a return of capital. So there's zero tax nature to the cash, which is really attractive. And we started that about 8-9 years ago. When we looked at it about a year ago, we thought, gee, we didn't do what we told people. We said we would, give them all the extra so they could spend it. The problem is, or maybe it's a good problem, the unit price had more than doubled even in this class, despite the fact that you're taking out 4% every year, or roughly 4%, and the distribution dollar amount had more than doubled. And so we went back and talked to, in fact, a lot of advisors who use that class, and we described what this second class, or we described moving to a higher payout, and they said, that's great that you think you can do it, but my clients are really happy with what they're in. So we, about a year ago, added a second distribution class, the D2, which had an initial targeted yield of 8%, trying to get to that number where, we think even with that higher payout, and of course it'll fluctuate, and of course it was down in March just after we initiated it, but now it's comfortably above the starting unit price, even with the fact that we're paying an 8% yield on that, or a starting yield of 8%. And in both cases, we'll look at it, and we should look at this soon because it's 1st of January every year, as to whether or not to adjust it. We've never adjusted it down. It's only ever been adjusted upward. And so, yeah, that's the way to get current cash from the investment in Turtle Creek. What's really happening is, of course, you're just in an efficient way redeeming a tiny little bit of your position each month, but having it come out as a return of capital. So like I said, it's really tax efficient.
For sure. Okay. Next question. And for those on the line, we are going to get to all your questions. We are certainly going to run a little bit over time here. So bear with me while we get through this. We'll try to go quickly. What is the minimum investment, and what are the fees that an investor pay? And also, what is the redemption schedule? Sorry, you hear my cat just wandered in here. I'm going to get rid of her while you answer that. So live TV, fees, minimum investment, redemption schedule.
Yeah, Avita, did you want to talk about the fees? And I'll just comment that with redemptions, it's what I said. There's no limit. If you want to take all your money back, it's just, the rule is we need to know 5 trading days before the month end. That's it. But there are no lockups, and there's no staging of redemptions. Like the underlying portfolio is made up of highly liquid public stocks.
And in terms of fees, you can think of us, you hear 1 in 20. So a 1% management fee, and then we take 20% of profits above a high water mark. High water mark being the fund's all-time high. It's at a fund level. So for example, if one invested last March when the fund was down 30%, you would have not paid any carried interest until we got back to our all-time highs. But the nice catch is that at the end of the year, if we have not returned 10% or more for the calendar year, net of all fees that have been taken off to investors, we rebate 0.75 of that 1%. So if we're above 10%, it's a 1 in 20. If not, that it's rebated, it's paid back to the investors on December 31st, it's added back to the NAV, and it's reduced by 0.75. So I know it's not a straightforward fee. It's not like any other funds you probably see. So if you have more questions, or I'm happy to go over it with anybody offline on the phone and talk about it, talk it through, because I know that it's sometimes hard to understand on the first go.
Sure. Okay. Okay, these are a couple of great questions. Your PowerPoint presentation suggests the carried interest allocation is 20% of profits above an undisclosed high water. Oh, this is what we were just talking about. What is the high market target? Said another way, what are the, okay, sorry, I'm
Yeah, so
regurgitating.
it's just the
Literally
fund's
just
all-time
answered
high.
that.
So if the NAV is 100 and then we fall back, and the NAV, the high water mark never resets, I should mention. So if the high water mark, the all-time high is 100, and then we fall down to 75, we will never take carried interest until we're above 100 again.
Got it.
Yeah, and Adam, I'm just looking, I can see the couple of questions. This is a good one from Randy Vanberg. Just how much cash do we typically sit on? We don't sit on cash. We aim to be fully invested. It happens that when COVID hit, we were up to an unusually high, well, unusually, I'd say we've never been above 10% cash since the spring of 2000, but we were at about 8% cash, and then COVID hit. And the one thing you should know about, because we're OM product, we are able to use leverage. We don't, and we average cash. So think of us as on average having 3% cash. We target to have 0 cash, but we will, when markets get dislocated, think COVID crash in March, we went into 7% debt. So we have an ability to use, the concept of using a bit of debt when things get stupid. At the end of 18, when the markets really fell sharply in the final quarter. So if you were to see, cash balances over the last 5 years or so, it would look like this. Like, it just taking advantage. Well, it shouldn't say it looks like this. It looks like this. Climbs, and then the market does something scary. It goes like this, and then climbs. And once or twice in that 5 years, we've dipped into a little bit of debt. I think at the end of 18 slightly, and then as I described for a month or two in March, April of last year. So we're targeting to be fully invested. We want to have our money working in good companies, not trying to play market and try to guess that the market's going to correct. And that's just, to me, that's a mug's game. And the problem is it works once for people, and then they become, anchored in that. I know there's a manager that did have more cash, went to some cash just as COVID hit. His relative performance, therefore, was pretty good in the shorter term. But then I made a point of checking at the end of the year, last year, he still has the same amount of cash, and his relative performance is lagging. I mean, the way I think about the market, if someone had told me, hey, there's this virus coming out of China, which we knew, which I was tracking, and this is the impact it'll have, the infection fatality rate is 0.4%, and I would have taken all that information. I would not have guessed that the market would have the sharpest sell-off I think maybe it's ever had. So I wouldn't have guessed that. I would have guessed a market reaction, but not the panic that occurred. And then I wouldn't have guessed that the market would return in the middle of the pandemic to recover all of that pretty quickly and be at an all-time high today. So it's as we say, we just own companies. Don't blame us that they're public.
Okay, got it. It's well said. 2 more quick questions, one written down. I've got one more. Can investment vehicle, can this be used in a registered account? RRSP, TFSA, LIRA, all that stuff? A follow-up question, and then I've got one more, and then we are going to cut it off. When is that high water mark determined? Is it just the all-time high, or is there a timing aspect?
And on a monthly basis. So
monthly basis.
Whatever the fund's all-time high price is.
Yeah, exactly. And we have no ability to reset. I mean, it's not something that we would ever consider. I just think it's bizarre that if you think back to the credit crisis, there are funds that earned a carry and then they went down sharply and then they just reset their high watermark and earned a second carry when things recovered. So it just gets set whenever we're at an all-time high.
Got it. Okay, last question. You mentioned, you talked about, nobody expected a global pandemic, but you did quite well through it. You talked about all of the economic conditions and the market conditions that work well for you. And oftentimes those are things that don't necessarily work well for others. What economic condition or market condition do you view as the biggest threat to your business? What are the things that could happen in the world, could happen in the markets that you feel would be the hardest for you to handle?
A war in Taiwan, North Korea going crazy with their nuclear weapons, an asteroid hitting the Earth would be really bad.
So in other words, things that we won't exactly be worried about our Turtle Creek portfolio. We'll have other things to worry about.
Yeah, I mean, so look, I read this once in The Economist magazine years ago. What really stayed with me is that there was an academic study saying that you read your history of the Weimar Republic in the 1920s and the hyperinflation and pictures of people taking wheelbarrows of cash to get to the bakery to buy bread before it, tripled again. And yet, if you'd owned the DAX, if you had your money in the German stock market, it's the one place where you would have come out the other end intact, which is a remarkable thing to step back and think about, better than owning gold. And so that's how I think about, productive assets. The real estate can be a productive asset. Bitcoin is not a productive asset. Gold's not a productive asset. Owning good companies that aren't going to hit the wall with too much debt. None of our companies hit the wall in the credit crisis or last year. I think that's a good place to be in pretty much any environment. And then the fact that you can own companies that are flexible and nimble, the way they have dealt with the pandemic has been, a real pleasure to observe. One of our company's Premium Brands, the specialty food company out of Vancouver, when I spoke to George, the CEO, last year, at one point he said, our focus has first been our employees and second been our customers. And you may not like to hear this, and only third our shareholders. And I said, no, I think that is exactly what your priorities should be. Because if you take care of the first two, then you're taking care of the shareholders. And I marveled at how our companies handled the credit crisis, and I've marveled at how they've dealt with the lockdowns and the pandemic. So I think it's that idea of owning highly intelligent, great companies. I think that's where you want to be in any environment.
Yeah, for sure. And I apologize earlier, there's a little confusion. There was a question about what is the minimum investment. I don't think it ever got, it is $25,000 through Raintree. So Andrew, Evita, everybody else who devoted some of your precious time today, thank you so much. This was really great. I had some nice texts come in during this call. There's lots in the chat. So thank you for that. And for those getting ready for a holiday season, we hope it's a safe one. We hope to hear from you soon. And yeah, so take care, everybody, and we'll talk to everybody soon. Thanks again for.
Thank you, Adam.
Great. Thanks, Adam.
Thank you.
Bye now.